I'm Mark Gagan, and you're listening to the Voice of Insurance podcast, produced in association with Advantage Go, enabling enterprise-scale underwriting through a single pane of glass. Some podcast interviews are really fulfilling to be involved with. Sometimes it's the rapport I have with the guest, and sometimes it's the subject matter and the insights that I find the most satisfying. Today's podcast is a rare combination because it's both of the above. Jeff Radke, co-founder and CEO at Accelerant Holdings, is clearly on top of the world in this interview. His business is absolutely flying. It's now employing around 375 people and is connecting an amazing 190 MGAs with 12 insurers and 66 reinsurers on both sides of the Atlantic. The organisation wrote just over $1.7 billion of premium in 2023. This is about 4 times the size the business was when we last spoke just over 3 years ago. Jeff is great fun to be around, but it's the vision and understanding of how the whole structure of large parts of the specialty insurance sector is changing that is what makes this such a good listen. Back in the old days, growth at this speed might have been frowned upon, or at least viewed with a certain amount of scepticism. Not now. These days, technological change means that the ultimate capital providers can drill right down into as much detail of the risks their capital is supporting as they want, and they can assess the quality of their book in almost real time. Jeff has had a career that has given him an incredibly detailed view of the insurance value chain, and his vision for how the new ways the constituent parts of that chain are sharing out the value that they create in much more meritocratic ways is fascinating. So, if you've been spending time wondering why the MGA boom seems to have continued unabated, even with a hard insurance market and a major reset in reinsurance, this is easily the most eloquent and enjoyable explanation you'll hear on the subject. You'll also learn of Accelerant's plans around captives, Jeff's thoughts on Lloyd's, as well as underwriting classes as diverse as fish drying and credit. Above all, this is great fun. Join us for a real tour de force. Enjoy the podcast. Jeff, welcome back to the Voice of Insurance. It's really great to have you back on the show.
It's great to be here. Now, Mark, you told me it was 3 years. It's kind of hard to believe, isn't it?
Well, I find it hard to believe. I don't know about you. I suppose we are both at the sort of age where time seems to go faster than you can remember.
Yeah.
So you will help my ailing memory and fill it in on what you've been getting up to. I know you were moving very, very fast. Well, give us an update on this Accelerant story so far. How many members are you up to? What sort of GWP volumes are you now writing, etc.?
Sure. The first thing I should say is we're incredibly fortunate to be supported by, you'll recall, we call the MGAs that we support members, just to remind us that we're servants, right?
I thought I did my homework and I remembered to call them members. I thought I didn't want to start off on the wrong foot.
For
Jeff.
your listeners, I wanted to explain what in the world I mean by members. So
well, I suppose it sounds a bit like Lloyd's otherwise or something, that sort of old Lloyd's names.
That's right.
Members,
that's a long time. That was a long time ago. But we currently serve about 190 members. I'm not sure how many we had when we last spoke, but it was quite a bit less than that.
Yeah, that's a lot.
Yeah. We've been very, very fortunate. We've expanded into Canada. So now we're in the US, Canada, the UK, and the European Economic Area. So that's 22 countries, about 240 products. And as I said, about 190 or so members that we're supporting.
What's your balance at the moment?
In 23, the US caught up to the UK and Europe, if I can be a little bit old fashioned and add those two together. The US caught up in 23, and because of the relative size of the markets, we would expect that the US will grow beyond that now, but they're both growing very nicely. And as we always tell each other, it's not a contest.
Yes. So you're kind of happy where it is. Well, I suppose what you said 3 years ago, you said that plan was to build a relatively small number of significant relationships where you can really make that investment in each other. Yeah. So do you think we're now with 190? Sorry, what was it, 190, 180?
Well, I know it's 180. So let's say 180.
It's at least 180. Sure. Do you think you're done now then in terms of, or there's just more, there are more deep relationships to be had?
Well, a couple things. Let's sort of pick that apart if that's okay. We are either the exclusive or certainly the majority capacity provider for every single one of our members. So those relationships are still really, really deep. We still have a long-term capacity commitment with each of them. We're still talking to them daily, meeting with them monthly. We're still very, very connected on a technological level. We're still very deep in their data and feeding back insights to them. So those relationships are really deep. We now have 375 employees. That's what's changed, is the team got really big so that we can have those deep relationships with many more members. Most of our growth over the past year and a half has been the result of inbound inquiries. You read a lot about network effects, but I think our risk exchange is sort of an example of how network effects works, where the size of the portfolio attracts more and more risk capital. Our execution's better and better for our members. That attracts more members, which creates more data, which makes the portfolio more valuable to risk capital, and a virtuous cycle. So we still feel like those relationships are absolutely key. We still feel like we are certainly the most important trading partner for each of our members. There's nothing more important in our world than serving those members. So while we're getting bigger, we've maintained the same ethos. I'm also delighted to say, Mark, that our net promoter score from our members is 91, was the last one that was done on our behalf by a consulting firm. And I don't know how familiar you are with net promoter scores.
Yeah, absolutely. So yes, that's pretty good.
Yeah, that's well beyond Apple. Yeah.
So I just had Dan Burrows on the show. So obviously they've now separated into the balance sheet and the underwriting business, and they have that incredibly close relationship. Would you say that's a similar sort of relationship that you've got, that you're the sort of Fidelis Insurance Group, and all of you've got 190 different sort of Richard Brindles out there, and you talk every day?
What we're trying to do is we're trying to let our members use their niche specialty expertise, because boy, there are more specialties than I would have ever dreamed of, right? Of course, I'm going to pick the weirdest and most wonderful, but the fish drying operations in Norway. We try to let those experts do their thing. And what we try and do is manage the portfolio and manage the risk capital. And the other thing I'd say is I suspect we're different because we really think about it in the context of a risk exchange. So we're kind of the infrastructure that's letting high quality specialty risk find its way to risk capital in as low a friction way as possible. You can tell I've got a picture in my head. This is audio, but I've got my hands up, and I've got the members, the MGAs, that's the supply side. And then you've got the risk capital, that's the investors, the insurers, and the reinsurers that want this business. And that's the demand side. And we get paid a fee to source, manage, and monitor that portfolio of business on behalf of the risk capital. Very simply, that's our business. That's the re-platforming of the specialty insurance market that we're undertaking.
Do each of those 180 have a totally different binder effectively through you, or
Yes.
They all do?
Yes.
So that's a huge amount of work. So you're really tailoring that capital to that provider, someone who really got that appetite and wants to understand that business more.
What's absolutely key, right? You remember the way the risk exchange works, both because of Accelerant-owned insurance companies as well as non-owned insurance companies that have wanted to partner. They essentially give us their pen, right? So risk capital gives us their pen. And then we manage that complexity. So what would look like a bowl of spaghetti in the traditional specialty market with binders going everywhere and brokers running around.
I think back to, say, 10 or 15 years ago when some of the MGAs, the international MGAs that have become the big global MGAs, they would be talking about rationalizing their binders. To say, oh, God, we've got 108 binders. We need to rationalize this down to 1 or 3 or 6 or whatever it was. Yeah. But you're not like that at all. Presumably, you've got the technology to be able to deal with that complexity.
What we say to the member MGA is you've got one binder. It covers on average 8 products, 1 binder, 1 relationship, 1 point of contact. And what we say to them is we take care of the risk capital. And we're taking care of that risk capital, not on a program by program basis, but on a portfolio basis. And it's so much more efficient. It's hard to compare. It's hard to compare the difference. Now, that means I'll date myself. There's a lot of key indexes in the databases that's keeping everything going to the right place, right? And that's complicated. And we've spent a lot of time and energy and money on the technology to make that work, but it's a key part.
And in terms of those carrier relationships, then I presume as you've grown, you've added more capital providers, more carriers signing up and giving you allocations of capital.
12 insurers now and 66 reinsurers have a significant position.
That's a large chunk of the market. And what about Accelerant's own position? Has it changed or stayed constant, or have you been able to reduce your own net exposure as an insurance company?
As a percentage of the portfolio, it's reduced as what we call those risk exchange insurers, i.e. the insurers that we don't own come on board. They're reducing the amount of business that rolls through the Accelerant insurance companies. So therefore, our retention becomes a smaller and smaller piece of the overall pie.
And of course, your diversification improves all the time. So actually, your real exposure is actually lower and lower all the time.
Yeah. And recall that after too many years in the catastrophe space, I'm reformed. And we now do almost no critical cat. Our portfolio business is really low severity, low limit, low hazard business, very small insureds.
Sorry to interrupt in mid-flow, but this is just a reminder that you could be advertising right here, right now, and getting your message directly into the ear of key decision makers in the insurance industry. And you'll be doing it while they're absolutely in listening mode. The podcast is the medium of the future, and so is audio advertising. Contact me on mark@thevoiceofinsurance.com, and I'll do everything I can to get you started. We were talking about this 3 years ago and saying, well, this is some of that nice volume business that reinsurers used to get when they wrote lots of quota shares and bouquets and all those things we used to have, and they don't get them anymore.
That's right. I think I said 3 years ago that the twinkle in our eye that created Accelerant was, at least in part, was that experience that I had of when I started my career, there were all those diversifying types of business that were floating around and they all disappeared. And boy, did it make being a reinsurer more difficult.
Because you were just moving higher up and just taking more of the severity and taking all the tail risk, I suppose, weren't you?
And we love being what we're told is a really important, valuable partner to balance out the barbell for a lot of the reinsurers. We love being able to play that part.
You're giving a huge amount of diversification instantly.
Right. We call it ballast. Because, you can buy however big a computer or however fancy a model you want. And in the end, people still ask, what's your loss ratio? And people still get very emotional if your loss ratio goes over 125. So having some ballast premium to go in along with all the exciting stuff that these experts write and make so much money on most of the time is really, really valuable.
Before we move on, I've quoted fish farms quite a few times. I don't think I ever end up with one as a client, but I had to quote lots of them. What do you do with fish drying? What are the perils there? Does it go moldy or is it lack of sun or too cold or too hot?
Rain or wind. And Frank O'Neill, our chief underwriting officer, I guess is the mark of a good chief underwriting officer. Every loss is like a wound to his pride, right? I remember one where it apparently got very windy up there and they all were blown over and blown into the sea. So wind would be the peril, but not the way we normally think about it.
I suppose it's sort of this dried salted cod or whatever it is,
right. Exactly
just blew
right.
away.
That's what it is. Yeah.
Right.
Into the water.
That doesn't sound good. I mean, funniest loss I ever had was electricity company, Spanish utility, was failure to supply electricity to an ice cream factory. Yeah, that was quite sticky.
You couldn't help yourself. Good.
So you've been riding this amazingly explosive growth, and partly because you've sort of hit upon a new model that wasn't there before. It's partly been a cyclical thing and maybe also a secular change. Do you think there's any sign that this explosive growth is going to moderate? We look at, say, that shift into excess and surplus lines of the last 3 or 4 years, all sorts of things, and the amount of business that is written by MGAs.
So let's divide it up. The E&S thing, the move to E&S, that feels permanent. And that feels permanent for a couple of different reasons. The regulators appear to be happy with it, which wasn't always the case. In my career, that wasn't always the case. That's the first thing. Second thing is the market seems quite happy with it. Third thing probably is what I should have started with. We've all gotten so spoiled in other parts of our consumer lives, having things very tailored for us. I think this notion of one size fits all GL or BOP, it sort of doesn't cut it anymore, right? And people insist on specialization, or they're certainly willing to seek it out. So that specialization is a trend that Accelerant is quite happy betting on, as are its members. We believe it'll continue. We also believe the more you understand the individual risk, they don't have to be giant. They don't have to be refineries to understand that a shop in London probably keeps inventory in the basement. That means it needs different flood coverage than a shop in the outskirts of Leeds who probably doesn't keep inventory in the basement because it'd be much easier to keep it down the street somewhere. Data is letting you be better at those things, and they deserve different products. Even if they don't know they need it, that's part of it. So anyway, I think specialization is here to stay. I think it'll continue. It's first thing. Second thing is, I believe this move to what people describe as this extraordinary growth of the MGA market, with many notable exceptions that sort of prove the rule. When I talk to underwriters, it's clear what they all want to be. You don't hear too many people saying, I want to be the property division regional vice president for XYZ composite, right? That's not what you hear. What you hear from the talented ones, what you hear from the experts, the specialists, is you hear they either want to start an MGA or they're inside an MGA. And Accelerant and its related business Mission, which is that MGA incubation business, is designed to facilitate that. But Mark, if we think about it, don't we see that happening in almost every industry? As technology gets democratized, it's cheap enough that the individual owner operator, I think, I'm going to bet on that, the individual owner operator over the big behemoth, the monolithic anything, bank, insurance company. I'll bet on the specialist every time.
Well, there you go. Podcasts, that's another one. Yeah, I'm a unit of one. I have no bosses and no employees.
Right. So media, let's take media, right? It's interesting. I don't think people wonder whether the genie's going to get back in the bottle in media. Only in insurance did we say, well, maybe
Rupert Murdoch's going to buy a really big printing press somewhere, and that's going to really just make it easy. No, it's not happening, is it? It's not going to happen.
I would say the same thing. You give people specialization, you give people independence, you give people ownership. Boy, is it hard to get them back on the farm.
Yeah. I suppose it was a very select club as well previously to say, I want to start my own balance sheet insurance company. Okay, I get the annoyance of having to do the things I'm not good at or the things that I don't like, having to talk to my regulator and renew my license. I don't like spending all my time with a rating agency where I could be with a client. And of course, these days you can fragment it down to, well, I'm a really good underwriter. Why don't I spend all my time with the brokers and with the clients, solving problems and creating new products and distributing products in new ways? Whereas I can let Jeff look after all the other stuff. And I presume they can still also capture such a large part of the value chain that they can add so much value. They can make their fortune, if you see what I mean, by doing.
For sure.
Before you had to make your fortune by asking someone to give you $500 million already, and you'd already kind of made it by that stage. You could start a reinsurer in Bermuda or whatever, and then you could grow value, and then you could float at a premium to book, and then you could have your share of that. You don't really have to do that anymore, do you? You can just produce a really good underwriting machine that is palpably producing predictable, profitable flows of business, and you can sell for 18 times multiple of that, can't you? So
I think you said something really, really important there. So maybe we'll, as the kids say, we'll double click on that for a second, right? So you have specialists just on the underwriting side, on the risk selection and pricing and perhaps product design side. And they become real experts and they capture so much of the value chain that they can make their fortune there. I agree with all that stuff because those businesses are very valuable in normal times as well as now, which is maybe even better than normal times. It's a very valuable business. But what's crazy in our mind, what's crazy is then the industry has decided that, at least in the United States, where I've got the numbers memorized, we're going to now produce 4,600 electric utility companies. Here's what I mean by electric utility companies. To have an insurance company, to talk to the regulator, to have an AM Best rating, to do all these things, to buy that policy administration system, to do all this stuff that feels like a utility, just feels like infrastructure, we repeat it every time for every insurer, every single time. It's just a colossal waste. And as you know, as well as I do, on average, the industry spends 14% of its premium dollar on that stuff, just the utility. So just as wherever you live, there's not a utility running their own transmission and distribution lines to each house on the block, right? We would argue that the risk exchange is the way for capital to get delivered on shared pipes. Because you know what? I think gone are the days about, oh, we've got an information edge. We can price this stuff better. It's not worth it. Let's just be fair and transparent and open, because the velocity of the trades will increase so much and the efficiency will go up so much that the real value of this portfolio of business is you have a financial flow that's uncorrelated to most financial assets. That's its value. And everything else is just complication. And what we try and do is we try and get out of the way with a lot of technology and a lot of experts on the front end to make sure that that portfolio business behaves well diversified, low risk, low volatility, and then just get out of the way and deliver it to the place where it's the most valuable. Sorry, I get all excited.
That's great. That's the most passionate and eloquent explanation of what you're doing that I've ever heard, actually. And it's very convincing. And anyway, when you have to look and see what you've been able to achieve in the last 3 years, to say that it seems like a good story and it seems pretty plausible to me. So you're out there seeing all the weird and wonderful of the world, which must be quite enjoyable as well, that you never quite know what's going to knock on the door tomorrow or this afternoon.
That's true.
So, fish drying in Norway, What other things? There's a lot going on at the moment in the market. Obviously, it's partly my job to keep abreast of all these things and get them on the podcast and ask them what they're doing. Had carbon credits insurance and those kind of things I thought particularly interesting and potentially high growth. But you're out there also as a kind of fellow hunter of all these interesting new things. What's caught your eye as being interesting new models?
We're spending, and I don't want to diminish how important it is that we create new products. I think we created 18 new products last quarter. So we're all in on that. I mean, we've got a big staff that's focused on doing that for our members, and it's really important. I have to say the biggest trend I see, Mark, is people are saying that captive insurance is really, really important. Today, it's a $170 billion industry in the US. There's much room for improvement.
Mm-hmm.
It works about as well as the traditional specialty market. It moves about that fast and has similar amounts of waste. And I think if I had to pick one thing over the next 12 months where Accelerant will be changing kind of people's lives, not to be melodramatic, but that's sort of our yardstick. That's what we try and do, is I think we can deliver a really much superior captive solution that gets people all the advantages of participation in their risk management for much less time, much less money in terms of efficiency. So that's the most exciting trend that I see.
That would be someone who says, right, I'm a sort of rent-a-captive, or I will be your captive through an MGA and through Accelerant. MGA, which has this relationship with Accelerant, we're going to do the things that are required, and we can do it a lot better than your traditional captive manager could.
I'd like to think because we've got all the pieces in the value chain that we need under one roof, so they're collaborative instead of competitive, we can put together what really is a captive. What's a captive? A captive is participating in your underwriting, right? We can deliver that to people in a much faster, more efficient, and less risky way. And the reason we can do that is we've got all the pieces. We're not fighting with one another, right? There's no spec and ag reinsurer. There's no fronting company. There's no captive manager. We can do it all in-house, and we can deliver solutions to those insureds or the associations or distributors that want to participate in their underwriting.
And the structure would be, do they become a capital provider to Accelerant?
A million different structures. Generally speaking, what we see are the tale of two cities. Some people want to put significant capital at risk. And what we do is we take that capital, we ring fence it in a way that they're very confident and comfortable that they're not exposed to any risks inside Accelerant that they don't want to take, right?
Yeah.
And then they are exposed to their underwriting risk. And at the end of X number of years, we tally up what the total was. And there's a very clean financial way for them to get their money out without having to go through a dividend out of a rent-a-captive in a domicile where the regulators quite rightly are worried about what claims could come later. We avoid sort of all that stuff. So that's one on one hand. On the other hand, we have the folks that are relatively capital poor, or they don't want to invest as much capital. And what we'll say is, look, you participate in the value chain. So you're creating some value. Why don't you put it up at risk if you'd like? So you don't have to come out of pocket from a capital perspective, but you could still participate to some degree. Now, normally that wouldn't work in a normal captive environment because everyone is set up to say, no, where's the collateral? Where's the initial deposit? And we're a little bit more flexible, as I said, because we control or own each of the pieces that you need to synthesize the solution.
That's really, really interesting. Anything else that has piqued your interest? Obviously, captive's a huge thing. I mean, it's such a huge opportunity, isn't it?
Yeah, it's really big and it's broad. It's broad across classes. And I'd be worried that if I picked out anything else, I'd be sort of just picking them at random. Thematically, one thing we see with some concern is we see credit coming back to the insurance and reinsurance markets. Depends how old you are, how many times you've been through this.
Well, I suppose it's the old adage, isn't it? People who have enough gray hair like us, sometimes an insurance company should stick to being an insurance company and not do things that banks don't want to do. And wonder, if the bank doesn't want to do it, why am I doing it? Why am I better at this?
That's right. And what I will say to your listeners is I recognize that that's an incredible cop-out, right? I recognize that the right way to do it is to use your intellectual capacity and be realistic about your expertise or lack of expertise and try and evaluate each opportunity in the context of, and this is important, in the context of our job is to back experts. Our job is not to be expert, right?
Yeah.
Our job is to back experts. I had a really interesting conversation with someone that I would consider a real credit expert not too many weeks ago. And we were talking about, how might this work? And I can see it. You have to find the right partners. Sounds a lot like everything else in life.
Again, it is just a risk. It just sounds more scary when it goes wrong. It does seem to have more systemic nature to it, as obviously we remember credit crises can happen. Yeah. And a lot of your portfolio construction can sort of go out of the window a bit at that point. And if there's no liquidity and all those things, that things that we don't tend to think about. We never think about liquidity being a risk in insurance because it isn't. That's right. You can't have a run on an insurance company, can you? But you can on a bank and on credit. Mm-hmm. Anyway, right. Let's summarize where we are so far in this discussion. Certainly, in terms of growth, you think there's a massive runway. Is that right? I'm not putting words in your mouth. I feel like there's a massive runway. I didn't mean to avoid the question, but I didn't get to it. I think we are just over $1.7 billion in 23 in gross written premium. So growing at some giant percentage of that gets harder and harder every year. I don't know what our percentage growth is going to be. Here's what I'd say. We're adding business faster each and every quarter than we did the year before. Well, why are we adding business faster and faster? It's the network effects. Once you have your risk capital set, and all you have to do is evaluate the quality of the business on the way in. And once you can deliver what the MGAs tell us is a very vastly superior solution, once you can do that, the flywheel starts to spin. So I presume as a secondary to that, obviously we've had an explosion of a peer group that didn't necessarily exist before of Accelerant's peer group. You don't think we are going to be at a point where that might start to consolidate in the way that these things often happen? And presumably a trigger for that would be a moderation in growth. But it often is, isn't it? That, we're not growing so fast, so we'll start buying other people type thing. Yeah. Mark, what I'm laughing about is you use the word trigger, and I'm going to use it in a different way. One of the easiest and fastest ways to trigger me is to say your peers, the fronting companies, because of course, I don't think Accelerant is one of those. You're completely peerless, Jeff, is what you're saying. It's a different business model, I guess is what I'm saying. I'm more comfortable with that. The former formulation sounded too tenuous. Sorry, I don't want to trigger you live on air. That would be terrible. Yeah, no, it's okay. So I guess what I would say is if you look at the fronting and the hybrid fronting companies, why do they exist? Largely, they exist to serve that MGA market, right? So as that MGA market continues to do well, I think they'll continue to be a place for them. But again, their business model is very, very different, right? They don't have risk capital sitting there waiting. Their business is not to be the vetter of quality, right? Their job is to transform it from insurance to reinsurance, right? Yeah. We view the risk exchange job as quite a bit different, bigger than that, right? So that's why we say that we don't view ourselves as fronting. Interestingly, there are two hybrid fronters that participate on the risk exchange, and they're really valuable partners for us. We sort of arrange the reinsurance following that sits behind them, but it is very, very useful to have high quality fronting companies that can issue the policies in areas where we either don't want to or can't for whatever reason, because these things come up, as you know. Right. Some of them are regulatory, some of them are emotional, but there are reasons that you'd like to use different insurance company paper at different times. In terms of, do I anticipate some consolidation? Geez, probably. Yeah. Because what I don't hear, maybe I don't listen closely enough, but what I don't hear is a capital crunch because they've got so much volume that they can't keep up. I don't hear that. And I suppose there's also lots of entrepreneurs are different types. Some people have a kind of 5-year clock ticking. And, if it's the alarm's about to go off, say, hey, why don't I sell now? I need to realize some value, take some money off the table, buy a new yacht or whatever it is. Then now might be the time when, you've got up to the billions and why not? It'd be a nice big number, wouldn't it? Yeah. And for the avoidance of doubt, that wouldn't be for us. I don't perceive us to be a buyer of fronting companies or hybrid fronting companies. But to your point, in terms of how do we think about the future, when I say we, that team of 375 people, we're thinking about operating and continuing to sort of re-platform the business. That's really, really exciting. And that's something that I think we've all signed up to do. I can't think longer than 5 years, but we all collectively as a group kind of sign up for 5 years each year. But we're really excited about demonstrating what this platform can do, because I just think it makes more sense, so much more sense, and not for everything, right? Again, I always compare and contrast it to some oil refinery or some pharmaceutical company buying liability. That's complicated stuff. And the experts are going to do that. And they should do it one by one, exactly the way the industry's set up. But for the bulk of this stuff, gosh, a common infrastructure where you just get that diversifying business, that zero beta flow to the place where it's more valuable.
That is, we believe, a real value creator.
Something else that's happened in the last few years is the emergence of a lot more, what we'd call it, follow only or tracker capital, or whatever you want to describe it. It sounds like that would be a good strategic fit with you. Have you been able to avail yourself of some of that capital? Because it sounds like it would be the sort of capital that would be attracted to something that you're trying to build.
Yes. Flywheel Re is our reinsurance sidecar. And we've also completed the first of a couple primary sidecars where we set up an insurance company with capital that's sort of tracker capital that says, go do it on my behalf. And that's what I really mean about the risk capital showing up for the portfolio, as opposed to they don't have a point of view about what exclusions should be on the business owner's policy, right? They say, you guys know how to run the portfolio for our capital. So you hate to do comparisons. And we're not particularly capital consumptive because of the portfolio of business and the low volatility we have. But even with that low volatility, a big chunk of the capital that sits behind the portfolio is exactly that. You could call it the tracker capital.
Well, it sounded like it was going to be a good fit. What about Lloyd's? Obviously, you know Lloyd's very well.
Mm-hmm.
And Lloyd's is in something of a golden era, I would say, and a lot of innovation going on, new structures, lots of exciting things happening. And I'm just wondering, does it correlate with anything that you're doing? Does it hold any attraction for you, particularly since there are so many different avenues you can go down? Or is it really you've kind of built your own mini Lloyd's anyway? You don't really need it.
Well, first of all, of course, Mark, I would have never done this, but I've heard others criticize Lloyd's over the years. I think we should take a minute to just say, wow, between the corporation and between the participants in that market, they've done it again, right? They've reinvented themselves completely. And bravo. If you want to point to something that they're struggling with, I suppose you can do that. You could point at something that Accelerant's struggling with. But I guess my point is Lloyd's has really changed their attitude, and Lloyd's has really changed some of their policies and procedures. That's hard to do in an organization that big and that old. So I have to tell you, from the outside looking in, incredibly impressive. I was there about 3 weeks ago, visiting with friends, old and new. I think the environment has changed enough that paper and that capital is, in the best of times, is just too analogous to Accelerant, right? The way we think about it.
Yeah.
If you think about Lloyd's at its best and you think about Accelerant at its best, it's too analogous for us to just be on separate sides of the street forever. I don't know what shape it's going to take, Mark, but for the first time since Accelerant was founded, I think Lloyd's interaction and partnering with Lloyd's makes a lot of sense. I don't know exactly what shape that's going to take yet, but we're excited to keep talking to our friends, old and new.
AA- rating and all sorts of things that weren't there before.
All that capital, all that expertise. We bring a lot of interesting things that perhaps Lloyd's could value, but think about how much Lloyd's brings to the table.
Well, again, if you have 1.7 billion of nice ballast business, then everyone would be very pleased to try and provide a good home for that, a very good home, an efficient home, one that works for you. Then that would be something, wouldn't it?
It would.
Good luck with that. It's always more complicated than things that make sense when you're chatting like we are now. Are often much harder to execute, but good luck with that. That would be really interesting. I think that would be extremely beneficial for everybody.
I agree.
I suppose the other thing that's really changed since we spoke 3 years ago, obviously, it was probably getting ready to harden the reinsurance market. And obviously, you have such a close relationship with so many reinsurers, being one of their conduits.
Mm-hmm.
It's hardened enormously. How did that affect your business? How did you navigate through that? And it sounds like you were able to do it. You didn't suddenly have to pony up and retain a lot more of what you were doing.
No, we didn't. Since 2018, we've made $450 million of profit for our risk capital partners. So that's how you have a relatively easy life in terms of...
You're in the good quadrant. Yeah,
you're in the good quadrant. We won't talk about deciles because I still have the marks. You're in the good quadrant. You're not asking the reinsurers to do the thing that, frankly, they have to slow down on, it seems to me.
And if you're not bringing lots of cat exposure either.
That's what I mean. If you're not bringing these risks that all go at the same time, right? If you're not bringing those kinds of risks, things are pretty good. And the other thing I'd say, and I have to admit, I missed this trick. This is a serendipitous thing that happened and I didn't predict it and I should have. With the technology, we're so much easier a client than the average client. The review process is a day instead of 2 weeks. Because you're not messing with Excel spreadsheets and trying to get all.
Because you just give them a code and say you can go and have a rummage around and look at what you want.
go look, which is sort of passive aggressive. So we say, yeah, sure, go look, but also here's the sort of pre-masticated triangles, and here's what I think you'd care about. So here are all the bits and pieces. And I think that really helps too. So diversification for their books of business, success, really, really, really extraordinary level of this didn't work, we fixed it. This didn't work, we fixed it. This didn't work, we fixed it, right? It hasn't been perfect, because perfect no one would believe, right? So we've had tons of problems, tons of products that we had to fix. And I think that's how you build confidence in your risk capital partners. So one of the things that we say to our members, which they value, or they tell us they value, is each year we have a member conference that you just mentioned. It was on LinkedIn. We were in Rome. And one of our sections is always the reinsurance market, status of the reinsurance market, because they don't know. They're completely insulated. So in their former lives, they would say, oh, hard market, sorry, you can't do it. Or hard market, your commission's gone way down. They lose touch with the reinsurance market because we take all that.
Yeah, you take all the beatings.
We take the beatings because, we're arguably the most experienced, right? Financially, the most capable. So we're the accordion. We're the shock absorber, maybe is a better analogy.
Yeah. So presumably you had to actually get a couple of reinsurance brokers in there, or a couple of reinsurers to give them a kind of, you did a panel on, by the way, this is what's happening in reinsurance.
Yeah, this is what your competitors are experiencing. This is the way we describe it. Your competitor MGAs, this is what's happening to them. Yeah, that's right.
Talking things that may have happened to other people, we had one of these periodic moments with this Vestu collateral. Wasn't necessarily there.
That wasn't.
Did that affect anything, or did it make life easier for you, or did that bring a whole load of new inquiries with folks who suddenly thought, well, I need to talk to you?
I don't know anyone who said that made their lives easier. I think some business flowed because of it. Frankly, Mark, not to us. That wasn't that kind of business. Those kinds of MGAs probably weren't Accelerant MGAs, right? They were spicier on average, right? But what did happen is, like, for example, one of our reinsurers, it turns out, retroceded to Vestu. So the collateral that they took turned out to be not valid. And so we had it wasn't tense. It was a bothersome moment. We had to wait for that premium to earn for that statutory penalty to go away. And I think we all learned a lesson there. I think we all learned a lesson that the insurance and reinsurance industry sort of sequentially runs into people from the outside who don't act like people from the inside. And we're always surprised, aren't we? Right?
Yes, we operate on utmost good faith. And then it turns out that not everybody else does. Who knew?
Yeah.
And also being an industry that sells pieces of paper for vast sums of money. And obviously at the reinsurance end, the sums have many noughts on the end of them. And
that's right.
It must be tempting to say, well, I don't have any capital, but I'll just send you a piece of paper saying, I've got a load of collateral over here somewhere.
Not really. It's sort of like it must be tempting to rob a bank. Not really.
Yeah, no. I know it's morally not correct. It's not the way you're going to get to heaven.
Yeah.
But you can see how it happens. It's a big temptation, isn't it? Because it's also theoretically quite simple. When you suddenly realize that actually it's really on trust. It's mostly on trust until you completely blow it.
Yeah. Yep.
Yes, it's a periodic reminder that you really do need to go and kick the tires of the capital and see if it's really there.
It's funny. Everyone came up with that conclusion, including us, Accelerant. We have to really kick the tires, and we do. And the conversation that I think was really valuable, that was had around the hotel table somewhere at Accelerant, was let's not lose sight of the first step, which is let's think about who we're doing business with really, really carefully, because that's the easiest way of all.
No, you're absolutely right. There's one thing we haven't spoken about yet on my list is technology. And I remember 3 years ago, you were talking about AI and technology more eloquently than many of the other people that I would have had on the podcast around that time. And of course, since then, again, another one of the things that's really changed is that AI suddenly sort of came front page news in the last 18 months. And it's something that every CEO now has to have an opinion on. But you were an early adopter. So where have you found it has added the most value for you within what you do?
Absolutely, without a doubt. The spot where it's added the most value. I'm going to tell you two stories, and they're actually the same story. I think I've decided, if you sort of really think through carefully what's happening. So the first thing is 180 members. I don't know how many products, over 200 products. That means every couple weeks, we get a status report on how things are going. Now, how in the world can a group of humans evaluate that? Mm-hmm. Right? How many losses came in versus how many did we expect? What was the rate and level achievement? How big are the insureds versus what we expected? How about the limit utilization? I don't know. What was the values of the underlying properties? It's just such a complicated knot, right? That you and I could pick one product and we'd do a great job. You and I would sit down, we'd take 2 weeks and we'd do a great job analyzing one product each for that month. It's a little bit limiting though, right? So by far, what's done the most for us is when AI tells us what to look at. AI says, this looks funny. This is way different than you expected. This is way different than the patterns would have predicted. And do we get a lot of false positives still? Sure. Is it much better than trying to hunt? Or I don't know what the alternative is, Mark, to be honest with you. So that's where it's made an enormous difference. The other place where it's made an enormous difference, and my colleague Kenny will be mad at me when I say I was surprised because he told me it would happen, but predicting which claims had the best recovery potential.
Wow.
And I guess in my mind, those two things are sort of the part and parcel. It's wading through just gobs and gobs and gobs of information. I won't say data, gobs and gobs of information, and saying either the people who set me up started me down a path where I think I care about this. And then, as you know, the models get better and better themselves in terms of what they care about. And it's just throughput, right? It's like throughput with a brain. When you think about the insurance industry and how much of that throughput we have, it's going to be such a game changer for Accelerant and the rest of the industry. Such a game changer. Yeah, it's amazing how good a job we do now because of the tools.
And of course, there's so much value in that information.
Yeah.
The loss ratio is a very large number. And if you can improve it by recovering more on certain claims, that's good for everyone. It means you can settle that claim quicker and you can settle it for what's net cheaper to you.
Yeah. And again, if you think about, not to be too philosophical here, right? And again, I'm not talking about refineries and I'm not talking about pharmaceuticals. If you just think of the insurance that we buy, right? That normal small businesses buy, gosh, what we need to do is we just need to make it much easier and much more efficient. And the way you get that is you get transparency. That's where it comes from. As long as we know it was bad luck, we're good. Pay and move on, right? And the more that those models can help us understand the propensity for loss and what's driving the loss and the fact that it was fortuitous or unfortunately not, it's going to make life much easier for all the good people.
Yeah. So that difference between, bad luck and bad design.
Bad luck, bad design, and bad behavior is the other one.
Yeah, bad clients. Yeah, there's always arson and there's always fraud and nasty things that we don't like to talk about. Jeff, I've really, really enjoyed our conversation. I feel really energized. It was really good to talk to you, and there's a huge man in there. So unless there's something you want to add, I know we've done a good job. I think I've really enjoyed digressing a bit and then coming back on track. And then I think we've spoken about everything that was on my list of things to talk about. Is there anything that you want to add before we go?
No, I really enjoyed the conversation. Thank you so much. And I think it was a fun tour de force. Is that the expression?
I think it was a tour de force. I'll have to put that in the introduction to you, Jeff. Thank you so much. I've really enjoyed it. And I'm looking forward to speaking to you. Hopefully,
maybe a year.
Let's not wait 3 years.
We'll do shorter. We'll do shorter.
Yeah, because, it sounds like there's going to be a lot to report on, that there's bound to be things happening between now and then. So I'm looking forward to it already, actually. Thank you so much. And good luck in between. Good luck, good design, and good clients. Good behavior.
Good afternoon. Thank you. Yes, sir. Bye.
Well, I hope you enjoyed today's episode. If you did, don't forget to subscribe or leave a like or a review or recommendation on whatever podcast platform you used to access this program. These really help get the word out. Before we go, just a quick reminder that advertising slots are available here and in other places in the Voice of Insurance podcasts. Podcasting is the fastest growing medium and attracts a high quality audience of key decision makers. It's also an intimate medium where you, the listener, are right in the room with me and the interview subjects. Needless to say, that means it's a great way of getting your message out directly to an audience because you've got their full attention. It's also very cost effective. So get in touch with Mark at thevoiceofinsurance.com to find out how you could be speaking directly to the industry. The Voice of Insurance podcast is produced in association with Advantage Go, enabling enterprise-scale underwriting through a single pane of glass. Voice of Insurance is produced by me, Mark Gagan. Music was written by Anna Gagan and produced by Carlos Gagan. Check out more podcasts and written comment pieces at www.thevoiceofinsurance.com.